I wanted to ask about Bitcoin, a big picture question over the next decade. Do you think it will prove to continue to be correlated with risk assets, or will it emerge to be negatively correlated in a way that you could argue gold perhaps has been over the long term, or the dollar has been in terms of its correlation with stocks?
What's been interesting about the correlations, Bitcoin to any other asset class, is the correlations have actually been very, very low over time. In fact, the highest correlation is between Bitcoin and real estate. Now, the IRS taxes Bitcoin as property, but I don't think that's the reason for this correlation. It just so happens it's that. So we think that as it becomes a better accepted new asset class, and we are seeing institutional movement into the space, and we're seeing the diversification of balance sheets from cash into Bitcoin, we do think it will behave, actually, I would say, more like the fixed income markets, believe it or not. If you think about bonds from this level, you know, this idea of a 60-40 balanced portfolio is a bit problematic. We've been through a 40-year bull market in bonds. We would not be surprised to see this new asset class become a part of those percentages, maybe 60 equity, 20-20. So I actually think that might be the biggest surprise here.
I wanted to ask about fintech as well. I know you're a big believer there, and I wondered whether you look at the incumbent financial companies and banks in a different light than perhaps you do the incumbent autos compared to Tesla, or the incumbent retailers compared to Amazon 10 or 20 years ago. Are any of the traditional banks, with all the investment they're putting into tech, whether it's Goldman with Marcus, Citi with their partnership with Google, or the investments the big banks have made into Zelle, whether any of those banks are investable as plays on fintech, or are they all going to get crushed like certain retailers and autos have been?
Well, it's interesting that you say that. We have often expressed a point of view that there's old DNA and new DNA. It's when the technology platforms shift, it's very hard for DNA to shift from old to new. That said, you've seen with Walmart, you're going to have a Walmart, a Target, a Costco. So you'll have maybe 2 or 3 mega banks. And yes, a lot of them are investing aggressively now, which is what they should be doing. But we do believe that the 2 of the biggest sectors that will be disrupted in the world today are the 2 that have been best performing this year: energy and financial services. So choose wisely and make sure you're on the right side of change. Make sure these companies are investing enough, have invested enough. So many companies simply leveraged up to buy back shares, and now they're facing this huge investment mandate. So make sure that you invest in those that will be the survivors. And we do think that the carnage is going to be pretty significant in both the energy and the financial services sector long term. Now, in a V-shaped recovery, and we think we're in a very strong recovery right now, they're going to do fine. They're going to do fine. And in fact, the yield curve is very wide by recent standards. So that should accrue to the benefit of financial services broadly. So we're not saying that this is a fake out short term, but we are saying long term, watch out.